Hey, it's Patrick Moore with Ironclad Wealth Management here, and I've got a quick video on what we call liability-driven investing. Now, it may sound complicated, but liability-driven investing is a simple, straightforward way to invest your money, and it forms the core of our investment framework. All it means is that if you need money in 3 years, that's your liability, and you should invest like you need that money in 3 years. Conversely, if you need money in 20 years, you should invest that a very different way than that 3 year money. So rather than just kind of taking that shotgun approach to your investment, it's about taking a targeted, calculated approach to reaching your goals, or in this context, your liabilities. Now, what we're going to talk about today is how you can translate that general information to an actual portfolio based on your liabilities. However, we are going to talk about some past performance. We're going to talk about some future projections, both of which are non-guaranteed, and obviously life can change. So when you talk about doing liability-driven investing, there's really three questions that you need to ask. It's how much do I need to fund this goal or the liability? It's when do we need that money? And it's what rate of return can we expect to achieve over that time period? And that's how you build your portfolio, and that's how you build your assumptions in your financial plan. So the first thing we need to do when we go about setting expectations and talking about that portfolio is go back and figure out how often and what has happened in history. So if we look at it in this chart here from White Charts, if you look on the far left, you can see that the stock market was negative about 26% of the time in 1 year periods. However, if we go on the right-hand side, you can see that historically, the stock market has never been negative on 15-year time frames. So when we talk about that 3-year versus that 20-year goal, it probably doesn't make too much sense to invest that money in the 3-year goal, but it probably makes a lot of sense to invest that money in the stock market for your 15-year goals. So that's the base of a portfolio. The question then becomes, how do you transition that into an actual allocation? And what we have here is just a generic little piece that shows you, okay, hey, if you need the money in the next 5 years, it probably doesn't make sense to take market risk because your investments could be down. However, once you start to move into the future, past 5 years, especially past 10, it starts to make sense to invest that money in the market at some percentage. And then once you get past 15, because historically the market has never been negative, it probably makes sense to invest that money fully in the market. So that's kind of a framework there. And then you have to back into, okay, so I'm going to do a 60-40 portfolio, but what can I actually build in as my returns expectation? And this great guide from JP Morgan has some good info. If we go to the left-hand side on the bottom, what you can see on the left-hand side is the 1-year returns of these various asset classes: equities, bonds, 50-50 equity bonds, and cash or treasury bills. So as we look at this, you can see that sure, the stocks may have gotten a 47% return in a 1-year time frame, but they also had almost three times the downside of the next nearest at negative 39%, which means that if you hit one of those negative 39% years, you're SOL with regards to funding your goal, and you might have to wait another couple of years to get it done. However, if we go over to the right-hand side, what you'll see on the 20-year time periods is that not only does that dark blue bar with equities have the highest in the best cases, which is 17%, it also has the best worst case scenarios at 6%. So the idea that the markets are risky is true short term, but it may not be quite as true long term. So what I want to do is I want to show you an example of how this may work and why it makes sense to separate and run your investment portfolios towards your liabilities. So let's do an example of needing a down payment for your house. Well, first we need to determine when you need the money, 2 years from now. Then we need to determine how much money we need. Let's do $50,000. And then we need to just figure out how much risk we can take to reach our goals. So we've got the stocks, minus 39% worst case scenario, and the T-bills, best and worst case scenario, 4%. So let's look at the stocks first. You're going to fund this goal at $25,000 a time for the next 2 years. So you got payment one, $25,000. If you have that negative 39% return, all of a sudden you only have $15,000, which means in year two, you have two options. Either you put additional money, $34,000 into it, or you buy less house because you can only afford the 25. In that scenario, your $50,000 down payment just became a $59,750 down payment, which, could work out for the best, but the variability on those returns is way too high for a short-term goal. The second option is to do T-bills. Same facts, $25,000 payment, 4% return, $26,000 balance, and then year two, you only need to make a $22,000 payment because you're going to get 4% interest there as well, which leads to needing $47,000 for your $50,000 down payment. So really what I'm trying to show you here is when we talk about those short-term goals, it probably makes sense to be a little bit safer. When we talk about those long-term goals, it probably makes sense to be a little more conventionally aggressive. But what it all boils down to is the fact that all of your money shouldn't be invested the same way. It needs to have thoughtful purpose behind what your investing goals are that's aligned with your liabilities and your financial plan. If that sounds like something you'd be interested in, that is the core of our investment framework, and we'd be happy to review your portfolio as part of a financial plan. Hit the Talk to the Advisor button up top, and we'll be happy to chat. Have a good one.